Well, welcome back into the Morning Blend on this Friday. We are talking all things taxes. Everyone's favorite thing to hear about on a Friday, but also very important topic. Nate Breiby joining us from Klaas Financial. And you kind of have all the tips and tricks people need to know about with the lots of changes that have happened here recently.
I'm trying.
Well, that's why they got to call you and talk about these things if they have any questions. But one of the first things I'm sure lots of people want to know about are those tax brackets, especially with kind of these 2017 changes now coming to be permanent. Can you kind of confirm what the status of those are going to be this year?
Yep, exactly. So this does all start with the Tax Cuts and Jobs Act, which was introduced back in 2017. Now that act brought in some lower brackets like the 12%, the 22 and the 24% bracket. Those, like you said, were actually set to expire at the end of 2025. Now comes the One Big Beautiful Bill Act that permanently extended those brackets. So we are able to enjoy those brackets until potentially another Congress comes along, and that's what we say, the tax law is written in pencil, not pen. So for now, that's what we know.
I was like, I've not heard that one before. That's actually a good way to describe it. So you can kind of plan things out a few years in advance, which is good that those things are pretty consistent. But another big topic has been that SALT cap. Like, even just explain what it is and what's changing there, because it can be kind of confusing for folks.
It is, but the SALT cap is what you're commonly heard it referred to as, and what that means, it's a state and local tax. So namely for us Illinois residents, state income tax, that's a flat 4.95%. That's included to be potentially deductible. Now, a bad word here would be property taxes.
Property people taxes. Get real upset. You got their ears tingling.
So right now in 2024, the SALT cap was $10,000. Okay. In this area, it's not uncommon to exceed that, where someone with $15,000 worth of property taxes would potentially only be able to get capped out at $10,000. So with this new bill, that is increasing up to $40,000. Okay. Now that's for the tax year 2025. This year, obviously, all the way through 29. Okay. Now, there are some phase-out ranges, okay? So what a phase-out range is, it means if your income is over a certain amount, so married, family, joint would be $500,000 up to $600,000, that cap will come down where they may be able to not get the full $40,000 of deduction. Now, lastly, it is an itemized deduction, so meaning not everyone's potentially eligible for that. But if you do itemize, that SALT cap is up to $40,000 this year.
Okay, so a bit of savings for folks if they kind of have that higher taxes that they have to pay, especially when it comes to property taxes. That's where a lot of people see that here in Illinois, especially. Now, what about any deductions for older Americans? Any new provisions for them? I know people have had a lot of conversation about that.
Oh yeah, so this you'll see in the headlines, maybe misinterpreted. So the current administration's goal on no tax on Social Security, that did not get included in this bill. Okay, so this new deduction is viewed by many as in lieu of fulfilling that campaign promise, okay? So what we have now is an additional senior tax deduction up to $6,000 per individual for those 65 plus, okay? So you can see the correlation. Social Security starts at 62 up to 70 potentially in that demographic, right? Is kind of the goal here. Now, this $6,000 per individual is in addition to a standard deduction, which in 2025, $31,500, plus an already enhanced senior tax deduction of $3,200. So we're going to add three pieces here together: $31,500, $3,200, $12,000 for a married filing joint couple. Say we're both 65. $46,700 starting in 2025, which is incredible.
Math person.
I added it up on the way here to make sure I got it right. Okay.
I was like, I can't do numbers that fast, so definitely going to come to you for any numbers advice, which lots of folks should be doing. But as we're talking all these things, let's talk specifically about those income taxes. Huge thing folks are very excited about: tips and overtime. What are the changes of how those are going to be taxed? And there's some kind of logistics people should know about it.
There are. So those were mentioned on the campaign train as well by the current administration. Those have been implemented to an extent. So a tax deduction for tips up to $25,000 per individual, which is a great benefit for those in the service industry, of course. Overtime as well, $12,500 per individual for overtime wages. Okay. Now, like everything, there's a phase-out range. So I'm using that term a lot, but that's important, meaning not everyone may qualify for these reductions in tips and overtimes, as well as the senior tax, as well as the SALT cap. So all check with your accountant on the phase-out ranges to see if you qualify.
Yeah, because a lot of people kind of get into filing, they kind of get lost in the weeds with a lot of the changes that happens, and that's kind of where Klaas Financial comes in, can walk folks through that. especially some of those pieces of legislation, like ones that have gained a lot of attention. Social Security Fairness Act, just briefly explain, if you can, what that entails and the impact it has.
Yeah, this is kind of a big deal. This was passed in January, where it kind of was unknown, at least from our perspective, and all of a sudden was signed into law. So what this was, this removed two provisions that were relevant in this area for teachers covered by TRS and maybe those covered by the SERS in the state here. So think of folks who didn't normally pay into Social Security. They were deemed as what called covered by non-covered pensions. They didn't pay into Social Security. So they may have had employment when they were younger that was covered by Social Security. They'd get their Social Security statement that said, Nate, you're eligible for $1,500 a month on your record. But actually come to find out, their TRS offsets some of that benefit. So that's called the windfall elimination provision. So two provisions got removed: windfall elimination provision, government pension offset. So these are a big deal. So if you know or know anybody that's covered by TRS or SERS in the area, they're probably going to want to call Social Security to see if they're eligible for more benefits on their own earnings records, a spouse's earning records, and unfortunately, if they lost somebody, a survivor's record. So it's worth a call just to call Social Security and reference the Fairness Act to see if you're potentially eligible for more benefits. And
absolutely.
One last thing, they actually are going to do a retroactive pay. So we've had clients get a lump sum check for benefits they were due to receive in 2024. So we've had clients get $15,000 to $25,000 checks in the mail for retroactive pay from 2024's benefits. So really, really cool provision. That's a fun phone call to make if you're eligible.
Hey, and some folks I'm sure watching this didn't even realize they could be eligible, and I'm sure that's the case you've had with a lot of clients, especially with all of these changes.
Exactly.
Kind of important to get some tips and to walk through with a financial advisor or your accountant and see what's going on, and it's a service you guys can help people with, correct?
Absolutely, yes.
So if people want more information, they want to talk to you, any of the other advisors, where can they go for the best information?
Yep, our website, klaasfinancial.com, and then of course give us a call at our local office. We're up on Perryville and Riverside, and we're happy to help.
Well, there's the information on your screen one more time as well. That phone number, it is 815-877-8440. KlaasFinancial.com for more information. You can get connected with them there as well. Well, thanks so much for being here, Nate. We appreciate your time and your expertise, and we'll be right back after the break.
Thank you.